Bismillahirrahmanirrahim. This is the first video on income flows versus cash flows, and in this video we will talk about a statement of cash flows essential under both US GAAP and IFRS along with the balance sheet and income statement. We will talk about cash flow categorization, where we will cover operating, investing, and financing activities reflecting different company life cycle stages. And finally, we will talk about interconnections of financial statements, where we will explain how the balance sheet, income statement, and cash flow statements are interconnected. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with the purpose of the statement of cash flows. The statement of cash flows explains how a company earns and spends cash, complementing the income statement. It links net income to changes in cash using the indirect method. It is split into operating, investing, and financing sections. It discloses all cash movements, and by stripping away accruals, it shows real cash transactions. Its main purpose is to clarify how cash received and spent affects the cash balance. Let us look into the Starbucks cash flow statement. Now, in the year 2015, the Starbucks generated 3,749 million from operations. They invested 1,520 million and obtained 2,257 million from financing in activities, resulting in a net cash decrease of 28 million. Despite this, their cash and cash equivalents decreased from 1,708 to 1,530, so a decrease of 178 million. Now, the 150 million difference between the net cash increase and the actual cash decrease is due to due to negative effect from the exchange rate fluctuations, which reduced the US dollar value of Starbucks cash holdings in the year 2005. Let us talk a bit about the difference between cash flow and net income. Now, cash flows from these activities, from timing differences. Uh, Now, you see, cash receipts and payments they occur at different times than when revenues and expenses are recognized on the income statement. That's why there is a difference between the cash flow and the net income. This is one of the reason, timing difference. Then we have uh, the impact of investing and financing activities, that is cash flows from these activities do not always immediately affect the income statement. Then accrual accounting measures profitability by recognizing revenues and expenses when earned or incurred regardless of cash timing. Accrual based income is considered more predictive of future cash flows than actual cash flows. Now, in case of income statement, manipulation through accounting adjustments is closely monitored and audited, while in the case of cash flows, it can be manipulated more easily by delaying payments or selling assets without the same level of scrutiny. So, cash is essential, obviously, for day to day operations, investments, and financing activities. And the statement of cash flows, they provide a detailed account of cash inflows and outflows, helping stakeholders understand cash movements and complementing information from the balance sheet and income statement. Next, let us talk about cash flows and financial analysis that plays an important role when we perform the 6 steps in financial statement analysis. Now, understanding the firm's cash flows is critical for financial analysis in order to identify the economic characteristics of a business. Now, cash flow patterns they differ based on the type of business and its stage of development. For example, high growth companies often rely on external capital for investment, while mature firms typically use operational cash for investments, debt payments, dividends, or stock buybacks. The statement of cash flows details how a company generates and uses cash. Companies focused on organic growth fund investments using cash from operations. Firms pursuing acquisitions use cash for purchases and raise funds through debt or equity financing activities. Uh, Cash flows differentiate cash and non cash components of unusual items like one time gains or losses and discontinued operations. It adjusts net income to reflect the impact on cash flows as it reveals how accounting decisions affect reported earnings through operating section adjustments. Then analyzing profitability and risk, that is cash flows, analyze profitability and risk. They track alignment between net income and cash flows from operating, investing, and financing activities over time. It also assesses the firm's ability to generate sufficient cash for investments and debt obligations, crucial for financial health. Then cash flows forecast financial statements that are essential for predicting firm valuation by linking income statement and balance sheet forecast to cash flow projections. It evaluates how the firm plans to fund future growth using internal cash flow or external financing. Then cash flows value the firm that is critical, especially in determining free cash flows available for distribution to shareholders after reinvestments and debt payments. It provides necessary data to calculate free cash flows, aiding in valuation assessment. Next, we will talk about the relationships among the cash flow activities. Now, operating activities involve cash flows related to day business operations, includes cash received from customers, and it covers payments to suppliers and employees. Investing activities covers cash flows related to long-term assets, It includes purchases and sales of equipment and investments in joint ventures. It encompasses cash used for acquisitions and cash received from asset sales. Financing activities encompasses cash flows related to capital. It involves raising capital through issuing stocks or bonds. It includes repayment of debt. It covers cash payments for dividends and share repurchases. And so these activities they typically occur in sequence. Companies first of all raise capital, then they invest in the assets, and finally they generate cash from operations. So they are going to raise the capital, that is number one. Then they are going to invest, that is number two. And then they are going to generate cash from their operations, so that is number three. So let us look into the cash flow activities of Starbucks for the year 2015. And you can see for the year 2015, Starbucks has generated 3,749 millions from their operations. Their adjusted net income by adding 934 million of depreciation, the largest adjustment. Then we can see that the changes in the working capital resulted in a 279 million adjustment, reflecting reduced investment in working capital. The positive adjustment of 137.7 million for accounts payable reflect a source of cash as the company allowed payable to rise. Coming to investing activities, they have used 1,520 million primarily for capital expenditures, totaling 1,304 million in property, plant, and equipment. Coming to financing activities, they have used 2,257 million and they have paid 929 million in cash dividends. They have purchased 1,436 million of common stock, and they have repurchased common stock. Okay, they have repurchased common stock for 1,436. So overall, these activities resulted in a decrease in cash and cash equivalents for Starbucks in the year 2015, a decrease of 178 million, which includes adjustments for exchange rate fluctuations, as you can see over here, impacting their cash balances. Next, let us talk about cash flow activities and a firm's life cycle. Now, understanding cash flow activities in relation to a firm's life cycle mirrors the stages of a product life cycle: introduction, growth, maturity, and decline. Now here is a simplified breakdown. You can see we have introduction phase, and during this phase the firm invests heavily in research, development, and market strategy and market entry. Cash outflows are high as investments are made in new products or services. During the growth phase, cash flows increases as sales expand rapidly. External financing might still be needed to support growth initiatives. During maturity phase, cash flows stabilize as sales reach their peak. The firm generates significant cash from operations, which can be used for reinvestment, debt reduction, dividends, or stock repurchases. And during the decline phase, cash flows decrease as demand for products or services decline. So, this phase may necessitate assets divestment, cost cutting measures, etc. These phases, duration and intensities vary across industries and product types. Now, firms with diverse product portfolios may experience different stages simultaneously, influencing the overall cash flow dynamics. Understanding these phases aids in evaluating a firm's financial health, strategic investments, and cash management strategies over time. Let us look into the pattern of revenue in the fourth phase of a in the four phases of a firm's life cycle. Now, during the growth stage, now being the introductory or the growth stage being the initial phase, it is marked by rapid revenue increase as product gains market acceptance. During maturity, revenue peaks as product reaches widespread adoption and stable market presence. During decline, obviously, revenue starts to decrease as customers' preferences shift towards newer alternatives. Some products may undergo renewal or adaptation to extend their life cycle, and it can happen in some industries and companies. Uh, Now, fast moving products such as semiconductors or fashion items, they experience quick transitions through phases due to technological changes or trends. However, staple products like Coca-Cola or Advil, they remain in maturity for extended periods due to consistent demand. In case of diversified firms, managing diverse products at different life cycle stages poses challenges in applying the life cycle theory uniformly. This requires strategic management to introduce new products and phase out older ones effectively over time. Next, let us look into the pattern of net income in the four phases of a firm's cycle. Now, during the introduction stage, uh, or during the, as we say, the initial phase, the firm typically incurs net loss. This is because the cost associated uh, with designing and launching new products exceed the revenues generated. During the maturity stage, net income peaks during the maturity phase, and this is when revenue stabilize and the firm achieve maximum profitability as it gains market share and optimizes operations. Now, net income declines in the declining phase of the life cycle, and this happens as revenues start to decrease due to market saturation, changing consumer preferences, or increased competition. In essence, the firm experiences losses at the beginning, reaches its most profitable stage in maturity, and then faces declining profits as the market conditions change over time. Next, let us look into the pattern of cash flows in the four phases of a firm's life cycle. Now, during the introduction stage, Cash flows are negative due to heavy investments in research, development, and market strategy. Financing activities provide the necessary funds for operations and investments. During the growth phase, cash flows become positive as sales rapidly increase. The firm starts to generate profits, although operational cash flows may lag due to investments in working capital and inventory. External financing supports continuing growth. During the maturity phase, cash flows are robust and positive from stable operations. Investing activities may also show positive cash flows as the firm maintains existing capacity rather than expanding. Excess cash can be used for debt repayment, dividends, or stock buybacks. During the declining phase, cash flows decline as sales decrease due to market saturation or competition. Cash is used to retire debt and may fund dividends or stock repurchases. Firms manage various product lines across these phases, influencing overall cash flow management, strategic decisions, and financial health. Understanding these phases helps in evaluating a firm's long term financial strategy and resilience against market changes. Now, the knowledge of competitive industry dynamics and trends can help us assess firm's level of cash flows. Uh, Technologically driven industries like biotechnology, Tesla, so industries like these they see peak investors' interest during the growth phase. Now, companies in these sectors focus on developing new technologies that lead to high profitable products. Tesla exemplifies this with its electric car technology, which represents growth potential compared to traditional automobiles. Then, many consumer food companies are in the maturity phase of their product life cycle. Brands like Cheerios maintain maturity through consistent quality and promotion. Now, these companies introduce new products to replace older ones, but they generally operate within the stability of the maturity phase. Then, industries like textiles, appliances, and automobiles in developed economies like the US are often in the early declining phase. So, factors contributing to decline include foreign competition, price declines, and outdated technology. Some firms in these sectors invest in advanced production facilities to compete globally and re enter the maturity phase. Others diversify geographically to benefit from foreign production, prolonging their maturity phase for product portfolios. So, understanding these industry dynamics helps evaluate how firms manage their cash flows, plan for growth or stabilization, and navigate through different phases of their product life cycles. Let us conclude this video by discussing statements of cash flows for four firms to contrast how these statements capture various stages of the product life cycle, that is, introduction, growth, maturity, and decline. Now, Atlas African Industries operates in support services for sectors like oil and gas, mining, and construction in Ethiopia and Liberia. It was established in 2012 and listed on London stock market in the year 2013. The company has undergone name changes and adjusted its financial reporting year end. Currently, Atlas African Industries is focusing on investing in Africa's industrial projects and expanding into consumer products such as glass bottle manufacturing for the Ethiopian beverage industry. As a startup, the company's financial profile shows, as can be seen, that the company has experienced increased losses annually from 155 million in the year 2013 to 9.5 million in the year 2015. Operating cash flows has consistently been negative, amounting to 0.84 million in the year 2015. The company has shown negative cash flows from investments totaling 8.7 million in the year 2014 to 5.2 million in the year 2015. Now, coming to the financing activities, positive cash flows from financing have supported operations with 6.9 million in the year 2014 and 17.8 million in the year 2015. So overall, Atlas African Industries cash flow statements indicate it is in the introductory phase of its life cycle, characterized by significant investment in operations and dependence on external financing to fund its growth plans. Then Umbrella was founded in the year 2004. It specializes in semiconductor chips for video and image products. After going public in the year 2012, the company has gained prominence in television broadcasting, security cameras, wearable devices, and drones like GoPro. So, as can be seen from the table, Umbrella's profits surged from 51 million in the year 2015 that is almost to 77 million in the year 2016. So it has surged by about, say, maybe more than 50% then operating cash flows more than doubled, rising from 52 million to 124 million in between 2015 and 16, a rise of about more than 100%, maybe about 125 or more. The company invested about 35 million in the year 2016, down slightly from 40 million in the year 2015, mainly for future growth projects. Umbrella secured significant funds from financing activities totaling approximately 9 million in the year 2016 and 15 million in the year 2015 to support expansion efforts. In summary, Umbrella exemplifies a company in the growth phase marked by substantial profit and cash flow increases, ongoing investments in technology, and reliance on external financing to sustain its expansion momentum. Then Cedar Fair LP was founded in 1983 and based in Sandusky, Ohio. It is a major player in the global amusement park industry. Cedar Fair consistently shows strong profitability with net income increasing from 112 in the year 2015 increasing to 112 from 104 million in the year 2014. The company generates substantial cash flows from its core operations, totaling 342 million in the year 2015. Cedar invests heavily in its parks, spending 178 million in the year 2015 to introduce new attractions and rides. So despite its profitability, Cedar uses 174 million in financing activities, largely for distributing profits to its partners as it operates as a partnership. As a mature firm, Cedar Fair cash flow patterns are typical for its industry, characterized by strong operational cash flows, ongoing investments in park improvements, and focus on distributing profits to partners rather than relying heavily on external financing. Then Warner Music Group was founded in the year 1929 and as a major player in music industry. It faced difficulties as the industry shifted to digital formats and streaming services. Warner Music Group reported increasing net losses rising from 51 million in the year 2008 to 145 million in the year 2010, reflecting struggles with digital transformation. Despite losses, the company maintained positive cash flows from operations, though these declined significantly from 304 to 150 million over the years. Investing activities were volatile, showing a negative cash flow in the year 2008 and 2010 also. So, and with a positive cash flow in the year 2009 maybe due to assets disposals. Now, negative cash flows from financing activities also, including a notable debt reduction in the year 2009. So, in summary, Warner Music Group cash flow statements reveal a company in the declining phase of its life cycle, grappling with losses amid the music industry's digital evolution. And despite challenges, it managed positive operational cash flows, navigated volatile investments, and addressed debt repayments. So this completes the first video on income flows versus cash flows, understanding the statement of cash flows. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.